Welcome to the Opportunity Zones podcast. I'm Jimmy Atkinson. Alicia Miller is head of U.S. capital markets at Black Salmon. Alicia, thanks for joining me on the show today. How are you doing?
I'm good. Thanks for having me. Happy to be here.
Happy to have you here. And Black Salmon manages over $2 billion in assets and has active strategies across industrial, multifamily, hospitality, and mixed use development. But how does Opportunity Zone investing fit into the firm's current strategy, Alicia?
So we're a real estate investment and development firm, and currently we have two active qualified opportunity zone projects underway for development. We have participated in QOZs in the past. Our most recent finished project was in the Wynwood neighborhood of Miami, where we were partnered with Bridge Investment Group as our vertical development investor, and we did a really wonderful multifamily project, and now we're going to be doing that in St. Pete as well as the design district in Miami.
Good. And your capital base, I'm curious to learn a little bit more about it. I know you have a lot of investors from Latin America, but which investor segments in particular? I'm talking about high net worth individual investors or family offices or RIAs or maybe some of your overseas LPs. Which of those are really interested and most eager for exposure to opportunity zone investing right now?
Absolutely. And let me backtrack a little to give you an overall view of Black Salmon. We're
Hmm.
2 billion AUM. Today, we're very heavily focused on residential and industrial. How we got to 2 billion AUM is with my founders being primarily South American, though they're US investors today, we were able to leverage a lot of our LATAM relationships to really bring foreign investment to US real estate. However, as we, uncovered opportunities across development spectrums, naturally some of our projects happen to be in QOZs. Now, who can benefit from that is primarily people either with a US domicile or are US based capital gains investors, right? So, who falls within that is typically high net worth individuals that are accredited, family offices, and then RIAs with specific mandates, registered investment advisors with specific mandates of clients with capital gains, right? So your institutional investors, they're agnostic to capital gains, just how they're structured. So we're really tiering more to that family office, high net worth advisory clientele.
Good. And but of those, those different groups, I would say which ones do you see mostly coming into opportunity zone investing?
Yep.
Do you get is your capital base mostly coming from RIA groups, or is it mostly coming from family offices, or is it mostly coming from individual investors, maybe smaller individuals that are probably smaller than a family office size?
Yeah, it's a mixture. I would say it's kind of across the spectrum. So you definitely have RIAs that probably function more as a multifamily office, meaning that they offer more alternatives. That's kind of how I define it, is that they're investing outside of, um, ETFs, mutual funds, bonds, yada, yada. So they're looking for capital gains related opportunities in the sense of how do I alleviate my client's position. So RIAs are great. Family offices, I would always say there's a heavy push with family offices because they're very sensitive to that capital gain structure. And then you do get your high net worth individuals. I mean, it's a mixture. I couldn't say it's one over the other because it really depends on the situation of what's happening to that investor that year.
Do you have capital gains? Do you have patient capital? I think those are the
Exactly.
two of the biggest questions to ask. Well, Alicia, I want to back up a little bit and get some background on you personally. How did you get to where you are today in your current position at Black Salmon?
Yeah, I had a really unique way of getting involved in real estate in general. I originally went to college for musical theater. I thought I was going to be on Broadway. Um, and then I realized, maybe that's not the path for me, and uh, picked up a communication studies degree at the University of North Texas. I was just, 21 trying to figure it out. Along that way, I had met my first boss who offered me an opportunity to work for his real estate investment firm in Denver, and put me directly on the capital development team. So I was starting to meet with family offices, high net worth individuals, et cetera, right away. Along my career, I've worked for several different real estate investment firms. About 4.5 years ago, I met Black Salmon in Miami and just really developed a strong relationship with the principals. I got to honestly watch from afar as they grew. And in 2022, something really unique happened for the firm. They became institutionally backed by a large LATAM financial institution called Lorraine Vial. And that's really what catapulted Black Salmon to be the institutional quality that it is today. Um, Towards the end of 2024, I just really liked what they were doing. They were doing some really cool projects. One of the QOZs I mentioned was in the Wynwood district, and I mean, in under a year, it was fully occupied. They had a huge quasi-institutional partner, and I wanted to be a part of it. So I reached out. We had always stayed friendly, and it seemed like it was the right time to come on board. And as we've grown, we really want to create more U.S. investor relations. So that's what I specialize in. As we become bigger, we want to get U.S. investment. We're a U.S.-based company. My principals are now U.S. citizens. We're all in.
That's great. Now, opportunity zones have been around for quite a few years now. The program inception was in 2018. Over the course of your time in the real estate industry, how have you seen opportunity zone investing or the perception of opportunity zone investing? How has it changed over time? How has it changed over the course of the last, I guess it's been just about 7 years now since the program first went online?
Yeah, I would say in a couple of ways. When opportunity zones started, I think there were actually a lot of advisory firms that were creating a multi-asset fund that focused on the capital gains tax related incentives, right? But what they discovered is you still need to find quality real estate, or you can also invest in operating companies, but quality investments. And so I think we've seen a change in, hey, let's not just go after, amassing a multi-asset fund and not necessarily being able to place that capital, because it is actually hard to find some quality opportunity zones that pencil. You can't just make everything work that's an OZ. So you've seen the transition of investors not necessarily wanting to be a part of those multi-asset funds because they haven't been able to place all of that capital in quality assets. You've also seen some hesitancy with investors, just as we're trying to figure out if QOZs are going to be renewed, what's that new program going to look like? I think you see some people waiting, right? Rightfully so in some regard. And then I would say I've come across a couple family offices recently that, excuse me, tend to be disappointed in some of the QOZs that they invested in, not because it wasn't a great investment, but because the full benefit of a QOZ is to be in it for that 10-year time frame. And some of these opportunities have exited in year four.
Yeah, and that's not what you ever want to see. You want to try to see these opportunities hold for the full 10-year plus period so you can get access to all of the tax benefits that go alongside of investing in opportunity zones. So what's trending right now? You mentioned that maybe opportunity zone investing, the appetite has waned a little bit. I think if you look at capital raising estimates. I always like to look at the Novogradac figures. That group publishes quarterly, and there was a big run up, a lot of capital raised in the first couple years of the program, and it's tapered off significantly over the last couple years, um, coinciding with a few different factors. Right, one, an external macroeconomic environment has changed a lot. The interest rate, the COVID, the interest rate spike, more uncertainty, but that has coincided with the program itself offering fewer tax benefits with each year that passes as well. I think that's one reason why appetite has waned. But what are you seeing, and what's trending right now with opportunity zones?
Yeah, I think it's a balance, right? So it's really looking at their overall, real estate or overall portfolio. It doesn't have to be real estate. I'm just real estate focused, and kind of seeing where they're at. I think the reason why you also see some pause in the environment is, like you said, interest rates, right? So a lot of alternative investments haven't exited. Same with any type of capital gains investment. A lot of mergers and acquisitions have slowed down because of interest rate environment. So you're not going to have a capital gains event there. Venture capital slowed down. You're not going to have capital gains events there. The market's been all over the place. You're not going to have a capital gains event there. And real estate transactions haven't really happened in the last 2 years significantly like it was before because interest rates remain high. Cap rates don't suffice to an exit for certain opportunities, and thus no capital gains events. So if you have less capital gains events, obviously you're going to see less benefit for those looking for QOZ, right? So I think, I would love for our interest rate environment to change because I think you're going to see a lot of release of capital and you'll see the build up of this program once again. And again, I'm going to highlight again, I think there's a lot more education behind QOZs today. A lot of people, again, advisors went after, multi-asset funds that specifically raised for this capital gains incentive, but not necessarily identifying qualified opportunity zone investments. And so as people were sitting in a multi-asset fund, their capital wasn't getting designated as quickly as they had hoped.
Yeah, I think that was a big problem, especially early on in the program too. The Opportunity Zones was a great new program. It was a great marketing hook for capital raisers to bring in capital from investors and to meet new investors and to go after a new class of investors. Maybe folks who didn't have real estate investing experience but had capital gains. Hey, come into my qualified opportunity fund. But then part two of that is once you raise the capital, you have to have a deployment strategy. And I think not everybody had a deployment strategy, or the timing for their deployment got caught off guard by the new interest rate environment that's hit us the last few years here. So yeah, there have been some issues with some qualified opportunity funds and some investors in some of those earlier qualified opportunity funds that may not have had that blind pool fund or that multi-asset fund deployment strategy in place. What do you see as, or how do you advise investors who may be somewhat familiar with opportunity zone investing? There's a few different ways to make an opportunity zone investment, right? I mean, we mentioned one of them. You can go into a multi-asset fund. Sometimes that's a fund that has a pipeline of identified deals. Sometimes it's a strategy, but it's
Mhm.
the pool of investments is not fully identified. We might refer to that as a blind pool fund. Then there's another way you can come into being an opportunity zone investor. You can go directly into a project. How do you like to advise your investors on what the best strategy is, common structuring, and what are the different pros and cons between those different strategies?
Yeah, I think that comes back to kind of your portfolio view. Do you like to invest in quote unquote direct deals, or do you like, to diversify your risk and be in a multi-asset fund, right? And I think you can benefit with both. What we offer at Black Salmon is for you to come into our qualified opportunity zone fund, which is then directed at one asset. So you almost have more understanding of the project at hand rather than a blind pool fund that's invested in maybe 10 QOZs. So you know exactly how those returns are going to dish out somewhat. Also, something we do at Black CMN is we have QOZ money come into a holdings company. So if, say, our development project in St. Pete that we're working on is to exit in year 4, we don't extinguish that timeline. We now can reassess that capital, put it back into the holdings company, and designate it to another QOZ. So it's not a multi-asset fund, quote unquote, even though I guess it's going into another asset. You don't have to stop that timeline. So now that 4 years happened, now we start year 5, 6, 7, 8, 9, 10, right? So you get the full 10 years and the benefit of, some of that depreciation and that reduction in the capital gains tax. Um, that's something that we're very cognizant to because again, I've come across investors who were super excited about QOZ, got invested in it in 2020, right? And the opportunity is exit in 2024. They didn't get the reduction in capital gains tax of their QOZ money that moved over, and now they're having to reallocate that capital
Yeah, that
and
could
start the 10-year timeline over rather
that
than having it continue.
Yeah, that can really blow up an investment. It's always beneficial to have that two-tier structure where the capital flows into qualified opportunity fund that then doesn't deploy directly into a project, but deploys into a holdco, and then the holdco holds the assets.
Exactly. Well, and I think we want to highlight something too. Qualified opportunity zones are consensus driven, right? So it's typically areas that are low income, and those areas change a lot. But if you're in a blind asset pool fund, right, a blind pool fund, um, and they're having a hard time finding opportunities, you may not always get the St. Petersburg, right, of Florida, that's now a booming economy, right? We're getting grandfathered somewhat into what used to be a low income area that's now booming, right? You might actually have some thriving projects, but also some that didn't gentrify, so to speak, right? And so I always like if it's for a purpose, like QOZ, you are designating these dollars because of this. I personally like direct in the sense, right? So I like knowing, okay, I'm invested in St. Petersburg, Florida. I understand what's happening in that area versus being in a multi-asset fund where I don't necessarily know everything. I'm not an expert everywhere. So I think from an educational standpoint, it's easier to wrap around one area.
Yeah, it's definitely easier to underwrite one project in one area as opposed to multiple projects across a wider area. There's pros and cons to both strategy, but
Exactly. I
I
mean, you
understand your point.
diversify risk, but I mean, this is again just for capital gains capital that you're looking for that reduction. It's not for your overall pool of capital for your portfolio, right? So I think if you're looking for your overall portfolio pool of capital, funds are great. We do funds, right? But if you're just looking for that capital gains, opportunity where you're designating capital for that reduction, you want to be involved in something that's going to do well.
Absolutely. Alicia, another common question that I'm sure you get from your investors is how is this different from a 1031 exchange or a tenant in common or a TIC strategy? Because there are a lot of similarities between opportunity zone investing and Section 1031 exchanges or TICs, but there's a lot of key differences also, right? But how do you guide your investors when they come to you with that question?
I think it really depends on the investor and what capital they need at hand. So a 1031 or a tenants in common structure is great in the sense that you are deferring capital gains tax, but you're having to invest that whole amount. So principal plus gains, right? You have to invest that equal amount, if not greater, into a new opportunity. The benefit of QOZ, qualified opportunity zones, is that you're only investing the capital gains tax. I mean, the capital gains event. You get your principal back. So now you have more of a say so. Okay, I got my $1 million back, right? And I had a $500,000 capital gains. We'll just use simple numbers. Now I can go designate my $1 million into whatever I want, right? I also get a reduction in the capital gains tax depending on how long the QOZ opportunity is. And then that capital gains money is rolled into that QOZ. You're also benefiting from not having to pay capital gains tax at the end of the QOZ, should it be the whole 10-year timeline. So I would say the benefit is you have a little more power and say so. You get some principal back versus just rolling. And sometimes people, they become, family offices change. So they'll be in wealth growth mode and then they want to go back to wealth preservation. So it just depends where they're at within that cycle of how they invest.
Yeah. And if I may offer a couple more comparisons,
Yeah,
with the 1031, it's a swap till you drop program, meaning you don't actually
yeah,
achieve the full tax benefit until you pass away, and then the full benefit actually accrues to your heirs, right? Opportunity zones, you achieve the full tax benefit after 10 years, so you don't have to die first. Another big, right? Another big benefit of opportunity zone investing is that the gain can come from anywhere. The gain can come from the sale of real estate, but it can also come from the sale of
yep,
stocks or anything else in your brokerage account, privately held business, collectibles, even Bitcoin or other cryptocurrencies. Whereas if you want to do a 1031 strategy, it has to be a real estate gain going into another real estate project. And then the one other big difference is the opportunity zones policy or tax incentive program is a place-based program. So you have to deploy capital into one of the 8,700 plus census tracts, whereas the 1031 is not geographically limited whatsoever. I think
Correct.
those are
And I think
those are the big ones.
the last thing to highlight is you can't 1031 into a QOZ project. It has to be capital gains money. You can't 1031 the whole amount. It really only it is only the capital gains amount.
That's right. Yeah, no, that's a huge benefit is that you can take that principal off the table, as you mentioned. So you don't have to, in your example, there's a $1.5 million transaction. You can take the $1 million principal off the table, just deploy the 500K into the OZ deal. But with a 1031, you got to do the whole 1.5 to get the full tax benefit. So well, very good. Yeah, that's a lot of the very, very common programs, both of them. A lot of similarities. They're both capital gains programs, but there's some key differences that investors need to be aware of as well. So, Alicia, we've talked high level about opportunity zones. We compared 1031s and ticks to opportunity zones, but I want to drill into Black Salmon's investment strategy right now. You've mentioned you have a couple of active opportunity zone deals that you're working on right now. One of them is in St. Petersburg, Florida. The other one's in the Design District in Miami. Can you tell me a little bit about both of those projects? What's the firm's investment thesis behind both of them, and what's the market opportunity in those two particular markets in Florida?
Yeah, so I would tell you that black salmon as a whole, our investment thesis, especially when it's in development, is we want to be in the best neighborhoods, but the entry point for Class A, right? So regardless of the fact that these projects are in QOZ, we wanted we like I said, we somewhat grandfathered into that because we just like the area, right? So alone, it needs to be a standalone qualified opportunity to invest in. It doesn't have to be a QOZ. We just happen to acquire land in these areas that had the benefit of QOZ. So in St. Petersburg, Florida, we're in the downtown area. We're going to be building a multifamily, Class A complex, and it's going to be right near the new Heinz Tropicana Stadium if that gets back underway. It happens to be in a qualified opportunity zone. The lower level, we're going to have mixed use retail. And really, how we look at multifamily and what was so great about our Wynwood multifamily project is we're the entry point for Class A with all the desired amenities. So we have the sauna, the steam room, the cold plunge. We have that really integrated indoor outdoor living, right? The dog washing stations. We want it to be a walkable community, but we may have smaller square footage apartments because we recognize it's Florida. People want to be outside. And so we get to invite investors in to, one, be a part of a wonderful development that's really going to revitalize the area, transition in that fun, walkable culture that is St. Petersburg, Florida, walking to the beach, to the restaurants, to the games, but also have that benefit for investors to get that tax incentive, right? By building just a beautiful quality product. Our other opportunity is in the design district in Miami. So the design district is unique. So the design district is basically, think of like Rodeo Drive or Fifth Avenue in New York. It's really become a hub for flagship stores for designer brands. However, it didn't start that way. It used to be, and I would say it still has this quality. It used to be where a lot of designers, home designers, fabric offerings, or what have you for um, home custom homes or home development. It's where people went traditionally for those services. It's since then become one of the highest square footage price per square foot rents in the country. So we had acquired a lot back in 2017, which happens to be a corner lot in the design district, and we're going to build a 3-story retail development. We've been propositioned by several storefronts that want the site. However, we're going to identify, our tenant at a later date just because rents continue to increase. So that opportunity we're super excited about. It's a premier location on the entry point of the design district. And again, we just happened to acquire a lot in an area that really transitioned and has become one of the top design areas, shopping districts in the country.
Yeah, and we're recording this episode toward the end of June 2025. What's the date here? June 24th, 2025. And I mentioned that because, just this month, the Senate Finance Committee has released a new bill, which is expected to be finalized any minute now or any day now and
Mhm.
voted on by the Senate. It's likely that once this episode airs, that bill will be made final and voted on potentially. But, currently what's in the language of the bill is it would make opportunity zones permanent, but it would create a new map of opportunity zones starting in 2027. I suspect that, especially considering that this current opportunity zone map was designated using pretty old census data, the 2010 census map, economic income data from the 5 years spanning 2011 through 2015. That data is 10 plus years old now. I suspect that a lot of these areas where Black Salmon is investing has since gentrified or received a lot of economic
Yep.
revitalization. It's probably a much different neighborhood in downtown St. Petersburg and in the design district Miami than it was when the program was first rolled out. I would suspect that these zones where you're investing are not likely to be eligible to be zones starting in 2027. So really, this is possibly investors' last opportunity to get into some of these locations in this current 1.0 map. Do you see it that way as well?
Yeah, I actually see it as a benefit, right? So rather than when this started in 2017, where you were betting a little bit more, taking more of a chance on some of the neighborhoods where you could see opportunity happen, um, we have the benefit that a lot of that change has already happened, right? And we're benefiting that these are QOZ designated zones, but they may not be in the future. So I think it's a benefit for investors because they have more clarity on the opportunity at hand versus that betting risk that that neighborhood could change.
Right. There's some concern about how the benefits of this current OZ program have waned quite a bit. The step ups are no longer available. The deferral period's only through the end of 2026, which back in 2018 sounded great, but now it's only 1 year. So the tax benefits of investing in opportunity zones today are not quite the same as they may have been 5 or 6 or 7 years ago, obviously, although the 10-year benefit is still the same. So if you start your
Yep.
10-year clock, it's the sooner the better. You can have a capital gain free exit at the back end. But the trade off is, I have a lot of people asking me, why should I invest in OZs now? Why not wait till the new program? The trade off is, and the benefit of investing now is because, like you said, there's more certainty in the areas that you're investing in, as opposed to waiting for an uncertain new program with an uncertain new map. Now, of course, we'll see that new map, we'll see the new program likely toward the end of 2026. But if you have a gain now, I say the benefit of investing now as opposed to waiting is there's just a lot more certainty in the program. And there's also a lot more certainty in the areas that you're investing in as well. I think to your point about St. Petersburg and the design district in particular.
Yeah, and I would also argue you never want to invest just because of the tax incentive. You always want to, as an investor, as an advisor, what have you, underwrite the deal at hand, right? So does it make sense regardless of my tax incentive? Does this deal pencil, right? So sometimes don't look at that timeline. Do you like the opportunity? Is it a benefit that now, if you're in it for 10 years, I don't have to claim capital gains on it on my capital within, right? So I think that's a huge benefit. And then again, if I can highlight again, Black Salmon, because we recognize that there could be an exit in year 4 or 5, not that we plan it, but of course we want to make our investor, we have that responsibility to make our investors as much money as possible. We put it within that holdings company, and then we can designate it to maybe a new opportunity zone that's been qualified, right? And then lastly, I would say that yeah, they're in great areas, but they weren't always. So, what's kind of motivating about qualified opportunity zones and that they're going to be made permanent is it really is changing neighborhoods that were low income. So it is working. I oftentimes hear, "Oh, how is that a qualified opportunity zone? It's the design district. It's one of the highest, price per square foot in Miami. Yada yada yada." Didn't used to be. So you can see that this program is incentivizing developers and investors to really change areas that maybe got neglected or ignored in the past.
Absolutely. The Economic Innovation Group recently came out with some new data. I can't remember the exact number, but it was somewhere around the ballpark of 350,000 new housing units have been created because of this opportunity zone tax incentive. That's a 350,000 housing units all over the country, and for a country that is suffering from a housing shortage, that's a very big impact that this one program has. Alicia, I'm curious, what are some of the biggest misconceptions that investors still have about opportunity zones? We're 7 years into the program, but I feel like not enough investors are aware of it, not enough advisors are aware of it, or to the extent that they are aware of it, maybe they miss some subtleties or nuances of the program. What do you see as some of the biggest misconceptions that are still floating around out there?
Um, that qualified opportunity zones aren't in desirable areas, that they aren't in areas of change, that they're not good pertaining real estate. They're not good quality real estate investment assets. I mean, again, that's where I highlight, do your underwriting. We don't invest because it's a qualified opportunity zone. We invested because we like the area. One big thing about Black Salmon is we focus on location. Location is everything within real estate. So we benefit as a happenstance that it's a QOZ, but we were going to be in St. Petersburg or the design district in Miami, no matter what. And we don't have to do QOZ, just because an area is QOZ, you don't have to do a QOZ program related to that investment. But we see the benefit for our investor base, so we decide to go QOZ.
That's good. And yeah, I mean, at the end of the day, it matters how does the asset perform, because this is a
Hmm.
10-year hold and the tax benefit only accrues if there is a gain at the end. So it better be profitable, right? So the deal matters tremendously. Alicia, it's been a pleasure speaking with you today. Before we go, where can our audience go to learn more about you and Black Salmon?
Yeah, so we have our website, Black Salmon. You can find me on LinkedIn, Alicia Miller Yoder. I put my married name on there. You can always email me directly, amiller@blacksalmon.com. I love to connect with investors, individuals, family offices, high net worth, and just kind of nerd out, right? Like, what is your program? What are you looking for? Have you ever invested in real estate? My background comes from a family of multi-generational investing in real estate. So love to nerd out, love to meet new people. Come find me.
Perfect. Yeah, go find Alicia, blacksalmon.com. And if you enjoyed today's episode, give us a like, hit that thumbs up button. We're going to have show notes available on our website at opportunityzones.com/podcast. I'll make sure to link to Alicia's email address as well as the Black Salmon website if you want to read more about today's show. Also, please be sure to subscribe to us on YouTube or your favorite podcast listening app to always get the latest episodes. Alicia, thanks so much again for joining me today. It's been a pleasure.
Yeah, thank you so much, Jimmy. It was great to be on.